let's get right to today's action. We have Mark Tepper, Strategic Wealth Partners founder and president, who will tell us why he is not worried about a short-term volatility in the market. And Scott Bauer joining us from the pits of the CME. Scott, we had a bad consumer sentiment number today, but hey, the market just shrugged it off. Why?
It's unreal, and I don't know if you can see behind me here. This is about the busiest it's been all day here. Volume has been so light, and there's been an incredible amount of buying coming in just in the last couple minutes. But going back to your consumer sentiment number, you know, everything that we see on the table, macro and here in the United States, Syria, but the budget, obviously the Fed meeting next week, there's just no stopping the market right now. And I think what has happened is with the rapid rise in interest rates that we've seen over the last couple of months, and now the digestion in the marketplace that we're going to see some sort of Fed tapering, that's now built in, and people are looking to say, boy, I still have this money on the sideline. I've still got so much cash on the sideline. I got to get into this marketplace. I mean, it's crazy. I mean, I think really next week, if we see anything in the realm of 10 to 20 billion, you know, tapering from the Fed, this market goes above 1,700.
Wow.
Mark, it sounds like the Fed is going to dominate the headlines here next week. So how do you anticipate markets will react?
Yeah, I think there's going to be some short-term volatility. You know, obviously, there's some pretty major announcements on deck from the Fed. For our clients, though, our investors, we're really more focused on what's going to happen over the next 3 years. And if there is a short-term pullback over the course of the next few weeks, we would definitely view that as a good buying opportunity, because when we look out, you know, not 3 weeks, but rather 3 years down the road, we think stocks are very, very fairly valued, attractively valued, and we think there's some good buying opportunities for investors out there.
By the way, what are you expecting from the taper, Mark Tepper, or are we going to have more than a $5 billion taper?
No. We're definitely expecting a pretty good taper, effective really as soon as possible. And
when you say pretty good, what do you mean by that? About a 10 billion or more, less than what they've been buying?
I would say over 10 billion, and I would expect that everything would actually conclude by mid-2014 as well.
Scott, what's the likelihood the Fed does not commence tapering? Especially we had the PPI, the Producer Price Index report, consistent with zero inflation in this economy.
Yeah. You know, I think the PPI and what you saw this morning out of consumer sentiment, I don't think that's going to factor into it. I think that the chances now are very minimal that they're not going to do anything. And quite frankly, if they don't do anything, which just a few weeks ago people were saying, you know, that's what a good thing. That's going to help propel this market. Now I actually think that that's a negative, because people are now looking beyond the taper. They're looking at fundamentals here in the U.S. And the fundamentals aren't so bad. They're not great, but they're not so bad. So if the Fed sends the signal that they're not tapering, that could send out some warning flags that, boy, oh boy, we don't think this recovery is anywhere near, you know, picking up any steam.
Well, Mark Tepper, you're not looking at fundamentals here as much as you are overseas. You think that Europe is a tremendous buying opportunity right now, not just right now, but for the next couple of years. Why?
Exactly. I mean, you know, when you look at what U.S. stocks have done since really the 2009 bottom, U.S. stocks have come a long way. Multiples have expanded significantly, and we just haven't seen that in the Eurozone yet. So with the Eurozone,
let me just get you straight, saying essentially that Europe, market-wise, is what the U.S. was, say, a year ago.
Exactly. I mean, there's so much more room for appreciation overseas in Europe right now, because they haven't done what we've done here. The multiples haven't expanded. The valuations look a heck of a lot more attractive over there. And, you know, we don't know what's going to happen. We don't know if the Eurozone stocks are going to outperform U.S. stocks over the next 3 or 6 months, but we do, when we look out on a 3 to 5 year basis, Eurozone stocks look considerably more attractive than U.S. stocks.
And Mark, let's talk specifics here. I know that Seagate Technology was one of your picks, down, unfortunately, nearly 6% since you told us to buy. Maybe we're just jumping the gun here. I'll cut you some slack there. And you also like Cisco. So begin with Seagate, and if you're sticking with it.
Yeah, so I mean, really one of our core investment themes right now is the fact that the capital stock in the United States is aging. There's been very little capital spending by businesses over the course of the last decade or so, and it's time for businesses really to begin to reinvest in capital goods. And we expect the technology sector really to be one of the biggest ways to play that trend. So within the technology sector, we like both Seagate and Cisco. Data storage is going to increase exponentially over the course of the next few years. You know, you've got a lot of small businesses who are really still trying to, turn their offices into paperless offices. And Seagate's a very fairly and attractively valued company with a great dividend, and that really fits our investment strategy. Cisco as well, nice, attractive PE ratio and a good dividend yield there as well. So, I mean, one of the best ways for us to play that trend is to hop right into the technology sector.
And regulators be damned. The heck with what they say about J.P. Morgan and Jamie Dimon. You like the company. By the way, you look at what it's done. I compare J.P. Morgan with Chase with Goldman Sachs over the past year. Goldman Sachs has increased much more than J.P. Morgan has. So it looks like if you consider them to be kind of equal in terms of where they should be, J.P. Morgan has more room to grow.
Exactly. I mean, you look at mean reversion, we would expect J.P. Morgan, therefore, to outperform over the course of the next few years due to that reason. It's got a great dividend yield. Again, a lot of our clients are, they're pretty successful people. They like to have more consistency in their portfolio, so they do appreciate the dividends. And when you look at all the financials that are out there, J.P. Morgan is really one of the best yielders. Not to mention the fact that, going back to the investment theme that I just mentioned, small businesses, companies investing in technology, it has to be financed somehow, some way. So, obviously the financials come into play there. And when you look at the financial sector in particular, J.P. Morgan's a great, well-run bank, and again, the valuation's attractive and it's got a great dividend yield.
Scott, back to you now. Can I ask you about gold? Closing down 17, 18 bucks an ounce, but a big call from Goldman Sachs today, putting it down to about $1,000 an ounce. Can you comment on that? Do you agree with that?
I don't want to fight what Goldman says, but no, in the short run here, I absolutely do not agree with it. We saw that the big pullback, just a few months ago, and gold rallied back. But, unless we see something completely out of the box this week with the Fed commentary going into the end of the year, gold may be a little bit weaker, but down, $300 from here, down, almost 25%. I don't see it happening. There's just too many stops in the marketplace in the low 1200s, the mid 1100s, if we even get back down there, that I just don't see it happening in the near term.
Scott Bauer, we're going to check in with you in a couple of minutes when the S&P futures close. Mark Tepper, have a fantastic weekend. Thank you so much for coming in. Good stuff.
You too.
Appreciate it.
Also, when we return, the #1 independent financial advisor in the